With that, we are ready to move on to our final segment for today, and we hope to get into a discussion on banking sector, which is known as the heartbeat of the country's financial sector. And we have with us Nimesha Jayakody from Frontier Research joining us. A very good evening to you, Nimesha.
Good evening.
Okay, first of all, can you talk about how the interest rates have been fluctuating during the past couple of months?
Yes, starting from around 2013 up until the end of 2015, the interest rates in Sri Lanka were falling. To counter this and to along with that reduce the level of credit available in the market, the central bank started taking some measures during the latter part of 2015, after which of course the interest rates started to increase. Stemming from all of this, right now we are also operating in a market or an environment with relatively higher bank interest rates than when we started this year.
Okay, if you look at the lending side of it, how did the loans perform during the last quarter, and any specific categories of loans you want to talk about?
Yes, so as a result of some of the measures taken by the central bank, we are with somewhat of a lag. We are now seeing signs of private sector credit growth slowing down. In line with that, during the most recent quarter, the total loan growth of local private banks also slowed down. That is the period from April to June compared to the previous 3 quarters. Another point which the banks themselves has pointed out as a reason for this slowdown in loan growth is that they are more selective about the loans that they give. As you know, there is a certain set of criteria the banks actually look at when someone comes to them asking for funds. Right now they are looking at these criteria a bit more strictly, and the filtering out process a little tighter to as much as possible reduce the probability of someone being on their loan books who's more likely than not to default on the loan payments. To answer the second part of your question about the specific loan categories. Yes, there is quite a bit of talk in town of a potential real estate bubble. Bank funding is of course a key part of these projects when it comes to their funding activities, starting from housing complexes, the apartments, as well as the usual home building activities. During a recent presentation by Fitch Ratings also, they mentioned that construction is the single largest sector that Sri Lankan banks are exposed to. So much so that by around the end of 2016, this was 17.5% of total bank lending. The exposure to real estate is also a very common question raised by people at banking forums. By simply looking at their quarterly financial statements only, it's a little difficult to give a view as to how the lending to construction sector has moved. The reason being that although there is a separate segment called housing loans, the construction related loans can also be actually included in broader loan categories such as term loans. So it's difficult to see exactly where these loans are included. Amidst all these concerns, however, the central bank had mentioned that they are very closely monitoring the level of lending given by banks to the construction sector. As the second category, I would like to touch upon the leasing category of the banks. So coming from a direction during the last budget in November 2016, the central bank took some measures to tighten the level of maximum loan to value ratios, which means basically that banks and other financial institutions can't lend as much as they used to for things like vehicle leasing. We are still seeing some growth in this sector, but
do we actually see a growth in the leasing?
Yes,
market?
There is somewhat of a growth, but at a much lower rate than it used to be.
Right. At the same time, it is very important that we talk about the repayment ability of the facilities granted. How healthy are the loan books? Are we getting repayments regularly?
Yes, when talking about the health of a loan book, we actually look at an indicator called the Npl Ratio, or the non-performing loans ratio. So a non-performing loan is simply when a borrower has been unable to make the interest payments or pay the principal amount for a certain bit of time. So lower the ratio, better it is for a bank. In fact, for some time, for the past few years, we saw the NPL ratios declining, which was a positive for the bank. One of the key reasons was the gradual decline in pawning facilities that the banks were giving, starting from around 2014. Originally, this was at one point a high source of like high NPLs, the pawning facilities. The effects of this scenario is now gradually going away. So during the last quarter, most of the banks had recorded higher NPL ratios.
Okay.
Another key reason pointed out by the banks themselves as a reason for the higher NPLs last quarter was the droughts and the floods that actually affected Sri Lanka. Yes. So a lot of people were affected, and it became increasingly difficult for them to pay back the loans. So it naturally went on to creating higher NPLs for the banks.
Okay, and can you talk about the profitability of this sector during the last quarter?
Yes, so the core income source for a bank is its interest income. During the last quarter, most of the banks were able to actually move up their net interest margins. Net interest margins is simply the interest that they actually receive on their lendings minus the interest that they have to pay on the deposits. So a lot of banks had improved their net interest margins. On the cost side of it, the total operating cost of the banks had only increased marginally during the last quarter. And in terms of employee costs, it has actually come down, along with the proportion of the taxes that they had to pay. So all these movements have worked positively for the banks last quarter, and they were able to actually record a higher profit overall compared to the previous quarter.
You mean to say the borrowing costs did not increase, though the lending costs increased in the banking sector?
Yes, they had been able to actually balance these out, and to have the spread, like enough spread to actually keep the profitability going.
Right, that's nice to hear. And in terms of strategic plans for future, any comments from the banks as to how they hope to move forward and grow their books?
Yes, there have been a few strategies that the banks have been talking about during the past few quarters and the last year. So one of the things a lot of banks are focusing on now is like technology improvements and automation. They are trying as much as possible to introduce a lot of technology improvements to reduce the amount of time that the people would spend in a branch near the counters. So this is to basically make it more convenient for the customers coming to a bank, and possibly in the long run to reduce the operating costs for a bank.
Okay, and there have been regulations imposed recently on this sector. So how have these regulations affected the entire industry?
Well, so one of the most recent regulations that the banks now have to adhere to are the Basel III Requirements, an international regulatory framework for banks, which specifies the minimum amount of capital that the banks can hold based on a certain set of criteria. As part of the first stage of these regulations, the banks had to actually meet the first hurdle date was the 1st of July this year. So at that point, looking at the financial statements, all the banks had been able to meet these regulatory requirements. The next stage of it comes on the 1st of January 2018, and by that time we see that quite a number of banks will have to raise more capital, and they will have to do so very competitively because they are in fact looking at the same pool of funds in the market.
Right, any new products being introduced to the market recently?
Yes, a lot of banks are trying and focusing on increasing the level of savings deposits that they hold as opposed to the fixed deposits, because naturally the savings deposit carry the lower interest rates. So in line with that, some of the banks have been introducing these new savings schemes to entice the public, especially focusing on women.
Okay, and my final question to you is, what is your view on how the banking sector will perform in the medium term?
So to understand how the banks will perform, one thing we need to actually look at is how the interest rates are moving in the market. So what we see is from around April 2017, the market rates had actually been kind of falling, like the treasury bill rates. So it is frontier researchers' view that these rates will continue to fall for another 6 to 9 months, but then pick up again. So generally what happens is the market interest rates translate to the bank rates, where the bank rates start moving the similar direction, rather after a bit of a lag. So there's still a window in the short term for the banks to profit from higher net interest margin. Even in the medium term, if the banks are able to balance their deposits, loans in a kind of a good way, they will be able to maintain healthy interest margins. Also, one concern that we can see in the sector is the uneasiness with the higher NPL ratios, like I mentioned before. So this is something the banks will really have to look into. And also we shouldn't completely disregard the possibility of a real estate bubble at some point in the future, which can affect the banking industry. To sum it up, overall my view is that the banks will continue to perform moderately well in like the end of the year and even into 2018. But this performance will have to be driven very carefully, looking at the longer term perspective. Because if the banks, which are one of the most connected sectors in the economy, kind of show signs of weakening, a lot of other industries will also start to feel this very soon.
Right. Thank you very much, Nimesha, for joining us today. It was nice having you with us.